Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Guys, the Fed is talking about cutting. It's not because of inflation. We're going to tell you exactly why they're going to probably cut and why you need to be watching out for it. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. You know, we have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
All right, Bob, wars, rumors of war, there's just a lot of stuff flying around, but you said stay calm and buy the dip.
Yeah, we'll show you a little bit later in the show why we're pretty comfortable with that. But the thing I really want to show you is the reason why when Powell cuts, the sugar high will be short-lived. And let me just throw it at you here. This is just absolutely amazing and scary at the same time. This shows you the inversions and drawdowns that you have with the stock market. And look at the area in which that we're already in between 2008 and 1929. I think we have 511 days that we haven't completed the inversion. And so in 2008, when the inversion flipped, we had over 50% correction. In 1929, which was the king of inversions, we had a drawdown of 80, I think it was 88% or some crazy number like that. So I think the Fed's like saying, oh, please, maybe can I make it to the next Fed president and let them start the cutting? Because once it happens, all hell's going to break loose in the market, Phil.
Yeah, and what we're dealing with now is there's a pretty regular pattern to all of this. And if we want to segue over to the yield inversion chart, basically what we're looking at on this chart here, you can see if on the top we have our yield curve inversion of the 2-year, 10-year treasuries. Okay, so that's what, when we're talking about yield curve inversion, primarily that's what we're looking at. You can also have yield curve inversions on like the 3-month, 10-year, but primarily this is the big dog. We thought we were getting a bottom in the yield curve actually back in March of last year. And why that's important is because when you get these yield curve inversions, if I zoom out here, you get pretty consistent reactions in terms of how the market will behave over the course of the next roughly 120 weeks. That's what these green zones represent. When you get a yield curve inversion, it starts the timer, and at some point you're going to go into a bear market. Typically, that's when the yield curve crosses up through the zero line, which is this white line, and goes into what we call the normalization phase. During that phase, you think, oh, the yield curve's not inverted anymore. That's good, right? No, that's when the bear market happens. The reason why the yield curve inverts is usually because the front end, the bond yields are dropping quickly. And typically because the front end is dropping faster than the long end, people are piling into bonds to save themselves from the market drawdown. So the 2-year or the 3-year bond is popular because that's typically going to cover your bear market, right? So they pile into that. Those yields drop faster than the long end of the curve. And that's why the yield curve, although normally the yield curve is positive, in this situation, right, it's a bull steepener, meaning people are bullishly buying the front end of the curve more than the back end of the curve, and so the yield curve steepens. Normally that's what the environment should be, but this is a bull steepener, which is actually a bearish event for equities. So that's the situation we're starting to get into now, right? We're waiting for this to turn up. So the reason why this has been flat primarily has been because Yellen's been issuing a lot of T-bills, and she has to kind of do that to float the current situation with all this debt they're issuing to try to get the turnover on that. But that can only go on for so long because at some point you can't keep up with short duration interest payments. And that is going to become a problem. So they will probably pull way back on that post-election. Whoever gets elected is going to have to deal with the problem they're creating right now. If it's them again, they're going to have to pay the piper. If it's a new president, then they're going to have to deal with it. So this is not a problem that goes away depending on who gets elected. This is a problem that will have to be dealt with after the election, and that's going to exacerbate our situation even more. So we got this ticker started now, Bob, right? We know now that this is the bottom of the yield curve inversion happened back here in June, okay? The 120-week window is begun. The other thing I'll add to this before I throw it back to you is that I overlaid the 2008 debacle on top of the chart. And lo and behold, we're just tracking right along with that fractal. Even this pullback we're experiencing here in the month of April is tracking, when it also implies that starting next week or the week after, we should see a bounce. And then we watch for the yield curve, this reddish line, to then start to move up. And once we hit that zero line, it should coincide probably with the highs in the market. It typically does. And at that point, you're looking at July. If we follow the fractal, we'll get a pullback and a final rally into September. And then we should see another pullback, which is also follows the seasonality. And then right before the elections, you get a bump up going into the election usually. But at that point, after the election, if we start taking out some of these swing lows, like the lows we just put in yesterday, probably an extremely important low. If we take that out after the election, I think it's full on risk off. You have to hedge yourselves or, go to cash, because now we're going to get into the meat, especially if this yield curve is going positive. Look out. It's the exact conditions that you would expect to see in a multi-month bear market at that point.
Yeah, and look, and the reason why these create bear markets is because it's not because, hey, interest rates are lower, I can put risk on again. It's because there's no risk appetite and they're chasing the market down to try to find buyers of debt. And when I mean buyers of debt, of new debt. And so everybody else gets scared and they roll out of equities saying, look, the easy money in 2008, Phil, if you just moved your entire portfolio from SPX to TLT, you made 47% versus losing 47%.
Right.
And people aren't stupid. They know that's going to happen. So at some point, this inflation game will go deflationary. It'll blow up the commodity trade and everything will go down, at once. And I agree with you. I think Janet Yellen she's preparing to burn the barns and the farmland as they head out of power this year, just like they did to Hoover in the 1920s. So Hoover took over and he took over a mess.
Right.
And basically he got blamed for the depression that was really the cause from the prior 8 years. I think the same thing's going to happen here, Phil. Right. And I agree with you. This fractal is kind of scary. But what should be more scary, guys, is that the longer this thing inverts, and look, at Janet Yellen is going to try to push this. So we're hearing that they're going to try to spend more money, and Janet Yellen is going to keep her bond selling at the low end of the curve. I think she's going to keep trying to do it until it doesn't work for them anymore, until everybody's choking on the leverage. And that's just going to make the sell-off that much harder. I'm going to make one other point, too. So all week long, everybody was talking about the reason why we're selling off was because of the war with Israel and Iran. And there was a gap to fill. You were calling it in the room. Kyle was calling it. But the rest of the market wasn't acting like there was a big war coming. And then yesterday, lo and behold, before OPEX, we've seen this a couple times, too, that Thursday before OPEX, some news event randomly shows up that causes the market to do this huge dump overnight. I was out to dinner. I came back, and so we're minus 70. I put in a room. I said, we'll probably be green by the morning. And we went up. I think we went positive there for a couple hours before we rolled back down. But I think this is normal event here for an OPEX that had a lot of contracts that needed to be blown up. And I agree with you, Phil. I think they're going to come out of early. Netflix had great earnings, but the stock price went down. I think they're going to evaluate their estimates, Phil, and say, hey, I think we have another quarter of goodness coming, which brings us to August 15th. That's kind of my date, my line in the sand that a high will be put in by that date, barring anything unforeseen. But that fractal is pretty scary. Remember, we started wiggling in summer of 2007 too. So I think this could be a really wild ride. And the interesting thing about it, Phil, is that this volatility is going to be extremely profitable. So I think there's going to be a lot of 2-3 day trades in there. You're going to have to change your horizon on this stuff.
Yep.
And then you have to slowly start building your hedge positions in, because you're going to make a lot of money next year if you're properly hedged or you're leaning short.
Right. And, this is not going to be just equities. Crypto, too, is going to get it. In fact, I would argue that crypto is probably going to get hit the hardest, especially with altcoins, because that's your most speculative segment of the market, right, is altcoins. I think Bitcoin, I think you have to look at gold to a certain extent and how it performs during yield curve inversions or steepenings. And gold typically doesn't sell off as bad as equities. It does get dragged down, but not as bad. So, will Bitcoin kind of follow suit? That remains to be seen. But, if you think Bitcoin's going to be immune to risk off environment, I think what we saw with the war reactions tells you all you need to know on how the market is treating Bitcoin. And it's basically a risk on play. So I wouldn't be surprised. I'm not going to, tell you exactly where I think Bitcoin would pull back in that situation. But if, let's say, we went back down to 20K for a recession, and even if we pumped over 100K, I would say, well, that's just Bitcoin for you, right? Super emotional. Over time, it's going to do really well, and its compound annual growth rate smokes any other asset, but you have to deal with the roller coaster ride of those types of returns. And I think altcoins would get absolutely obliterated in a prolonged recession as well. Well, here's a chart of Bitcoin. You know, we got halving coming up in a few hours. Bob halving's in about, I don't know, 9 hours now. But if you look at like the weekly chart on Bitcoin, I mean, just a monster move. I'm expecting it to break out of this blue box essentially, but we're in a little bit of a correction here. It's a decent correction, but even this correction isn't nearly as much as we've seen in the past in this move, where we've seen upwards of 25%, which would that could take us down to like 55K possibly. Still, we'll see. A lot of times after halving, we get some weakness, and so it's potentially that we see one more push down. We do get that lower level down there toward 55, and then finally we start to move out of here. I think overall, as you guys saw with that fractal, we'll probably see some sort of move out of here after this dip going into May and June, July. I'm actually pretty excited about that because I think everyone's portfolios is going to do very, very well over the next 3 months, and I think the move will kind of melt faces actually. So even though this looks really bearish going out 6, 8, 9 months from now, the shorter term people are going to get euphoric, and so it's kind of a funky environment because you're going to have just elation before the storm, and you got elections. So it's a wild ride. Stay tuned. We're going to keep you abreast of what's going on, but this is definitely one you're going to have to do the Texas two-step around.
That's right, guys. If you want to trade with us, go to tradelikeagenius.com, and we'll give you the algorithms. We'll give you the access to the chat room, put trades out. And we think we have a pretty decent pulse on everything here now. And I think it's going to be awesome for those who are going to be nimble. So have a great one. We'll catch you guys tomorrow.
See you later.
Trade Genius.